So a couple of weeks ago, I had a very interesting discussion with one of my followers on Instagram who was quite disappointed by her money market fund returns. So I was recommending them as a high yielding savings account, and she came into the comment section to say that she didn't think that money market funds were a worthy investment because she invested X amount of money and got like less than 50 shillings as a return on her investment, which really got me thinking about investments and the returns we should be expecting. And I felt that it is important to maybe address this one issue about investments where people are finding themselves quite a bit disappointed with their investment returns. So in today's episode, I'm to talk about 3 major reasons why you may find yourself quite disappointed with your investment returns and what you can do to improve that situation. My name is Susan Wanjiko. Thank you for joining me on another episode of Finance Friday. The first and the major reason why you may be quite unsatisfied with your investment return is unrealistic expectations and unrealistic comparisons. There are 5 very important questions to answer before you get involved in any investment. And these are the questions. Question number 1 is, where is my money being invested? Ideally, that helps you to understand which is the underlying or what is the underlying asset of that investment. If you can be able to understand that, then it's easy for you to answer question number 2 and number 3, which is, what is the risk associated with this investment and what is the return associated with this investment. We have low risk investments, medium risk investments, and high risk investments. And the level of risk also determines the level of your return, because the lower the risk, the lower the return, and the higher the risk, the higher the return. So that's question number 1, 2, and 3. Then we have question number 4, which is, which of my goals does this investment serve? And a lot of us do not ask that question because we are too focused on chasing the returns, and we never stop to ask, does this investment choice align with any of my financial goals? And if it does, which ones exactly? And then question number 5, how can I best leverage on this investment? You see, if you're not able to understand that, then you will find yourself having very unrealistic expectations of some investments or unfairly comparing them. Now, I love to tell people this. As much as I will recommend a money market fund as an alternative savings option, I'm recommending them as an alternative to saving in your traditional bank account. All right. But at no given point should you expect bond-like returns from a money market fund. A money market fund will have interest rates that are fluctuating or oscillating between 7 to 10%, just depending on the prevailing market conditions. While bonds, on the other hand, will give you anything between 11 to 13%, depending on the duration of the bond, right? So when you're getting into an investment, if you find yourself quite disappointed with your return, I think the question would be to ask, what exactly was my expectation in terms of a return? Again, a lot of us do not run the numbers. When an investment claims to give you 9% per annum and you invest 9,000, ask yourself, how much will I actually get as an investment return? Right? So that is 9% times, if you're using the straight line method, it's, principal times rate times time. If you're using compound interest, which is what the money market funds use, then there's a formula for compound interest. We actually have quite a number of compound interest calculators. I'm going to link one down below that is on my website that you can use to calculate exactly how much money you're going to receive if you invest X amount of money. Now, stocks are stocks, bonds are bonds, money market funds are money market funds, SACCOs are SACCOs. At no given point should you compare a money market fund with bonds, or the return you'd ideally get from a business to one that you'll get in your SACCO savings account. You need to manage your expectations. All right. If you don't manage your expectations, then you're going to be very super disappointed with your investment returns because you are expecting too much from too little. If you invested 100,000 or 200,000, you obviously are not going to get the same return as someone who's invested 500 bob. If you just invest 10,000 and leave it there, you're not going to get the same return as someone who has invested, 10,000 and they top up another 10,000 every month. So you really need to work around understanding these investments, what exactly they do, how they work, how your money will grow if you put your money in that investment. That way it is very easy for you to manage your expectations. Also, the lower the risk, the lower the return. So if an investment has low risk, for instance, money market funds have low risk and they come with a guarantee of capital preservation. Obviously, the return is not going to be as high as had you put your money in a high risk investment, maybe even real estate or venture capitalism or even a business. The return cannot be the same. So you really need to understand the risk and return trade-off for different investments for you to be able to understand beforehand, before you get into it, what exactly you need to expect. So manage your expectations and don't compare different asset classes with others because it can never be the same. They can never compare. All right. The second reason you may be disappointed with your investment returns is actually not understanding the recommended investment horizon of a particular product or a particular investment option. Now, I'll give you a good example. The first time I put money in a money market fund, and this is one of the reasons I really related to that follower of mine who raised this concern. I was very disappointed because I probably got 12 shillings, but I had invested maybe 3,000 or 2,500. I can't quite remember, but I know it was less than 6,000 or 5,000. Obviously, I was quite disappointed because I was wondering, okay, what was the hype? Everyone has been talking about this money market funds. What exactly is the hype? But then with time, the more I kept contributing, I use money market funds a lot because I'm a fan of goal-oriented saving and goal-oriented investments. So I have different money market funds to help me meet certain goals in my financial journey, right? And so the more I kept contributing into these money market funds, and now I've done it consistently for 4 years. One example is my emergency fund, which I do not withdraw from very often because I only withdraw from it in times of emergencies. And I have been observing the kind of interest I used to get during the first year and how much interest that I'm getting right now that I've been contributing consistently and every month for the past 4 years. It's not the same, all right? So it's moved from the 12 bob to 50 bob to 70 shillings, and now I'm getting 1,000 or 2,000 as an interest from my money market fund on a monthly basis. Okay, and so understand the horizon. Exactly how long should I invest in this product for me to get some meaningful return? Because some of us put money and within the first 6 months or even the first month, you're already complaining. Guys, you haven't earned the right to complain if you've only left your money invested for a month or two, because you've not given your investments time to grow, time to compound. All right. So it's like investing in the stock market, and within the first 2 years, you want to get crazy as returns or dividends. That's not how the stock market works, because in order for stock market prices to go up, that reflects the growth of an economy. And it also reflects the growth of companies, and no economy or company grows overnight. Okay, so you want to ensure that you understand the recommended investment horizon for particular products, so that you don't expect returns from the stock market after 2 years, and when the return doesn't come, you give up on it. Yet had you exercised a level of patience and invested for 5 years, 6 years, it would have started to make sense. All right, so understand the recommended investment horizon. Understand that you cannot put in very little money for 1 month and start complaining. That's very ridiculous, guys. And what this does to us is that it discourages us too early, and we give up in instances where patience and consistency would have really paid off. So understand the recommended time horizon of a particular investment and whether it is required that you invest consistently. So unless you're putting a big lump sum amount of money, most investments actually require that you invest regularly, whether that is on a monthly basis or on a quarterly basis. You don't just put 20,000 and leave it in there. You need to stay, think of investing as a lifestyle, guys. It's not an event. So put money, start with your 20, 30, 10, 5,000, but you have to keep investing consistently and regularly so that your capital can increase and your interest can compound. Give that time. You will find that most investments actually make sense when you give them time. All right. The third reason why you may be disappointed with your investment returns is that one, you've not diversified your investment portfolio because you fail to understand that different investments serve different purposes. Okay, so when you do not diversify your portfolio, you fail to have a proper mix of risk and return. If all my money was in money market funds, guys, I cannot claim to be, working towards financial freedom, because you cannot financial freedom your way through money market funds because they're very low risk, very low return. So I need to understand, for instance, if I use money market funds, I'll be honest with you guys, I use money market funds purely for goal-oriented saving, okay? Or as a parking fees to accumulate money for other types of investments. But if I want to make wealth in the long term, I cannot just put my money in money market funds only. I need to think bonds. I need to think stock market investments for the long term, maybe even business. All right. So you need to have a proper mix of low risk investments, medium risk investments, and high risk investments. I've also come across people who put their money in all their money in very high risk investments, like you have your entire portfolio in crypto, or you have your entire portfolio in the stock market, or you just do business only or real estate only. That is also risky. So if you just have very low risk and conservative investments, there's a problem with that kind of approach. You're going to move very, 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 very slowly. Okay. But there's also an issue if your entire portfolio is in high risk investments, because if anything was ever to happen to your money, then you're going to lose a lot of money. So you need to understand how to properly mix between low risk investments and high risk investments. Okay. So I'll give you an example of a good portfolio, or one that is a proper mix of the risks that we are discussing. You see, if I have two money market funds, one is serving as my emergency fund and maybe the other one a sinking fund, I have that. And then maybe I have a bond fund. If you've never heard of this, I have a video that I've done on a couple of investments. I think 7 investments that you can make with as little as 5,000. So I'm going to link it down below just so that you can familiarize yourself with what these investments are. So you can have a bond fund. A bond fund is a collective investment scheme like a money market fund, only that a bond fund will invest your money in corporate bonds and treasury bonds through your fund manager. So you see the level of risk is almost medium. And then maybe I have a bit of my money going into maybe offshore investments, or even just the Nairobi Stock Exchange, which is a bit high risk. Or I have some of my money that I've chosen to invest in a particular business venture. So you see, all my money is not just in one asset class that is low risk, or one asset class that is high risk. It's a proper balance. So you need to understand that different investments will play a very specific role in your life or in your financial life. Some are for preserving capital, others are for multiplying your capital, others are to give you passive income or dividends in the long term. You need to do goal-based investing as well. All right. So if you can be able to manage your expectations, if you can be able to understand the recommended amount, the time horizon, and if you can be able to, first of all, answer the question, what are my goals and which investment will serve this goal, it will actually help you to, feel less disappointed with some of the investments that you're making. Now, these are not the only reasons why you may be disappointed in your investment. It goes without saying that some investments are actually disappointing you because they are just the wrong investment, or you thought they were an investment but they are really not an investment. I'll give you a good example. There are people who buy insurance policies as investments, for instance. And so you'll find that someone has taken like an education policy that barely compensates them for inflation, or you find that someone has taken like an endowment policy or whatever insurance policy, and your expectation was that it was, however the product was sold to you, you were told that this is insurance, but it comes with an investment benefit. The problem with these kinds of products sometimes is that, you'll be told that there's going to be a bonus and whatnot, but like, an insurance product cannot serve you well as an investment product. Insurance is risk mitigation, while investing is capital multiplication. If you use one in place of the other to replace another, then you have a problem. So sometimes it's just that you've been sold a product that is not necessarily a good investment product, and that is another reason why you can actually find yourself quite disappointed with the return, because what was sold to you versus what you end up getting at the end of the investment term is not very pleasant. So do your best to do your due diligence, and I'm just going to recap again. Where's my money being invested? What is the risk associated with this investment? What is the return of this investment? Which of my goals does this investment serve? And how can I best leverage on this investment? If you can be able to answer those 5 questions, then you have figured it almost more than halfway whether that investment will work for you or not. In case you're interested in learning about investments, I have an Invest for Your Best Life masterclass. I'm going to link that masterclass down below. It has become a popular one on my Instagram. Guys are crazy about this course because I took the time to teach you everything about unit trusts in this class. So we've talked about the money market funds, the bond funds, and all that. We've talked about the government bills and bonds, how to invest in the stock market, and how to do proper retirement planning. And this class comes with a bonus email with recommendations of Kenyan companies that you can invest in. So in case you're interested in taking the class, it's a 3-hour pre-recorded masterclass on all things investing in Kenya, those 4 assets specifically. I'll link it down in the description below. In case you're interested, just grab it, get your notebook, your cup of tea. You're gonna be there a while, but it's definitely going to be worth your while. In case you also need to watch a free video on the different investments I said earlier, I'm going to also link it down below so that you can just familiarize yourself with these investments. So let me know in the comment section if this video was helpful to you. And in case you've ever been disappointed with an investment, tell us why and which investment it was. I'm going to be taking some time to respond to the comments. Remember to like this video, to share, and to subscribe